So Brian Silvestri here, real estate broker, and I have a very, very special guest tonight, which is Marsha Morency, who I've known for, I would say about 16 years, Marsha, right?
Time, yes.
Yeah, a long time. And Marsha is a mortgage professional with more than 17 years of experience in driving growth and customer excellence. She has strong finance professional skills in sales, refinance referrals, FHA financing. She's certified in 203K renovation lending, a program particularly well suited for buyers of fixer-uppers and foreclosed homes in need of repair, where buyers can finance both the purchase and future repairs of their new home with just one loan. And she works very hard, for your business, and will provide you and your family with the best professional service and mortgage solutions that make the most sense for your family. And being that I've known her for 16 years, I can speak firsthand of that experience. So first of all, thank you for being here tonight with us, Marsha.
You're welcome. Thank you for having me.
Yeah, so we first got to know each other 16 years ago when you were working on the renovation loan financing for Wells Fargo.
Yes, yes.
So
The foreclosure properties.
yes, absolutely. And for those of you that just to give you a brief summary, real estate in general was deemed essential services very early in the pandemic, and now today we entered phase two. So we can pretty much do almost everything at this point. Now we're liberated to do showings of vacant properties, or as long as the owner steps out or the tenant steps out, if it's a rental property. And myself personally, I've been very surprised at there's been a lot of activity. So maybe we start there. Like, what are you seeing on the lending side as far as activity, both like during the pandemic and then also even like now?
Very, very busy, like you said.
Hmm.
We get some hiccups with appraisals, whether the house is filled with people. They are, a little hesitation from them to go inside. But other than that, with the interest rates so low, we are very, very busy.
Hmm. Okay, good. That's good to hear. And for those people that are not familiar with FHA financing or Sony Mae financing, these are programs that you can buy with sometimes as little as 3.5% down. And just last year, one of my clients was a 26-year-old professional who bought his first home in the Bronx, two-family property that he actually lumped in the closing costs into the mortgage and also money to renovate the house as well. So this is the expertise of Marsha. So Marsha, can you talk a little bit about some of these programs, what's out there, and just kind of giving, especially the people who've never heard of this, a little bit of background.
The 203K or the Sony Mae? Which one?
Yeah, either one, like whatever programs that you work on that that people can buy with a lower down payment. I think when we were talking the other day, you said maybe sometimes it's 10% or sometimes it can be 3.5%. So give us a little bit of background on Sony Mae, FHA, 203K, the different things that you deal with.
Okay, so with Sony Mae, we can put as little as 3% down. There's the Achieving the Dream program. There's the low interest rate program. And that now they have a program called NRP. You're able to put 3% down, anything over $500,000. They give you $15,000 down payment assistance and a $20,000 grant for repairs. So that's pretty cool. It's income limit also. So when I pre-qualify people, I have to make sure the targeted area versus the non-targeted areas, whether or not their income is permitted to purchase houses there. 203K, the bare minimum is 3.5% down. We can do seller concession. And Going back to Sony May, you can stack grants as well with Sony May programs. So
Mhm.
there's a lot of detail with both programs. The 203K program now, we give you, there's the limited where we give you up to $35,000. And then there's the full 203K where we can go above $35,000 with structural work, addition, and converting properties from a single to two or from a 4 to 3. We can do units from a single family all the way up to a 4-family home.
Okay, so like a 203K for those of you that are just hearing this for the first time. You find a property that's in need of work. It could be something, could be a foreclosure. It could just be something that where the person has not done any updates in a number of years, or as Marsha's kind of talking about, you take a one type of number of units, you change it to another number of units, right? So, and what you can do is you could lump in. So if you're buying a property for 500,000 and you need 50,000, then you can put 50,000 on top of it, and add that into the mortgage. So you'd get a mortgage of, let's say, 550, and to cover the cost of the renovation. Is that more or less a pretty good summary?
Yes, pretty close. It's
Yeah.
like you said, the 500,000 plus the
Mhm.
50, and we subtract the down payment from the acquisition cost. Then when we close, we have to put the renovation monies into an escrow account. Those funds are dispersed in draws as the work is being completed. So before we close, we're going to hire a licensed contractor. The clients are going to go out there and vet their contractors, make sure they've been licensed and insured for the past 3 years. They're going to give us a detailed cost estimate breaking down each and every work that's being done to the property. So that way, when we close, we know how to disperse the funds. So it's either 2 to 3 draws if it's less than $35,000. And if it's over $35,000, depending on the amount of the renovation, the draws could be more.
Okay. And what are the limits on these type of loans? And are we only talking about 1 to 4 families, or is there a possibility that something like this could be done for a condo? What are the general limits and guidelines?
We can do 1 through 4 family, co-ops and condo. Well, no, those are on the conventional renovation program. A lot of co-ops are not FHA approved. This is an FHA program. So I would
Okay.
like to say a single through 4 family. We can also do mixed use properties with 3.5% down. So if you find out if you have a borrower that's looking at a mixed use property, maybe a 4 family in a store or a 2
Mhm.
family in a store, we will consider that as residential, doing the 203K loan. And the renovation monies in an instance like that cannot go to the commercial space. It has to go to the residential.
Mm, okay, okay. And and we were talking the other day, like, um, in general, for people that, let's say, are going for a pre-approval, or starting the process for the first time, like, in general, what type of guidelines would a lender use to determine if somebody is qualified to get a loan? And how do the qualification, the guidelines kind of differ a little bit? And I think we were kind of talking about the other day, just referring to like the debt to income ratio that I think that you mentioned. So can you give us an idea of like like if you just get a person that's not interested in a 203K, but they just want a regular conventional loan, what is the normal guideline? How would they know if they're qualified, and how does it differ with some of these other programs that you're dealing with?
The the FHA loans versus the conventional loan are more geared to first-time home buyers where their credit score needs a little work or their debt to income ratio is a little bit on the high side.
Mhm.
Whereas where conventional loan, they have a strict 620 FICO score and above, of course, and cannot exceed 50% back-end debt to income ratio. With FHA, we used to go as high as 57, and since COVID, they reduced it a little bit. So 54, 55 is their mark. And also their credit score changed, where before we used to go as low as 580. Now you'll find with different banks, they have added layer of risk where it's maybe 620 or 640, or even as high as 660 with FHA loan. So now it's a little juggle between the two. So when the borrowers come to me and present their information, I can guide to see which program best fits their needs.
Okay. Okay. Interesting. Okay. So I think you were freezing up a little bit. The audio is continued to come through, but just we're freezing up a little bit. I think it's better now. Um, but all right. So what I heard is is that there's the you have some flexibility in terms of credit scores, in terms of and also in terms of the debt to income ratio. So can you just explain, like, if we have like very first time type of people on, that'll be watching this, like, what does that mean, debt to income? How do you figure out that? I think I might have lost you.
The debt to income ratio is
Yeah, now you're back. Okay,
basically
go ahead. Yeah, your
the
video
debt.
is kind of freezing up, but I'm hearing you fine on the audio.
Okay.
Go ahead.
The debt to income ratio is basically the debt of whatever's on your credit report
Mhm.
plus the debt of the subject property that you're looking to purchase. So you add those two monthly payments together and you
Okay.
divide that by your monthly income, and that gives you your debt to income ratio.
Okay. So you're talking about like all of your installments. So you have a car payment, you have what you owe some credit
Credit
cards.
card,
So it's like the whatever the minimum payment is on the credit card,
correct,
right?
correct.
Okay.
Now
Student
with
loans.
mhm. With
Okay.
student loans between FHA and conventional, they're a little bit different. With FHA, regardless whether you're deferred or you have a low monthly payment, with FHA, we have to use 1% of your balance.
Hmm. It's really interesting, one of the things that you said about, this with certain programs, the credit score is like under 600 is okay, or low 600s. I mean, I find it really interesting because I'm renting an apartment and the owner won't take a credit score under 700, you know? So
Yeah.
in order to rent an apartment, and as just an aside, it's kind of it's unique in that you know um, the rental law has changed in such a way so that the owner, I'm not sure if you're aware, but the owner can only take 1 month's rent, 1 month's security at lease signing since about a
Right.
year ago. So
Right.
sometimes I get people that are on the borderline of, they have good job, they have a little bit of money in the bank, but their credit scores are like 630, 640, and they know that they can only give 1 month's rent, 1 month's security, and because it's
Mhm.
so difficult to potentially evict somebody, landlords can be very scared to take somebody with that type of score, and yet there's programs for people with just a little bit of money and job that they can buy something.
Yes, yes. And with Sony May, they are not credit score driven.
Hmm.
They just want you to have made your payments on time for the past 24 months. And if you had a one-time incident with a letter of explanation, and depending what the issue was, they may be able to approve you with that.
Wow. That's very interesting. That's very
Yeah.
interesting. And what is the for these programs, or just in general the loans that you work on, what do they look for in terms of, you said debt to income, but like how far back are they looking at someone's income? And let's say for someone that's self-employed, how does that differ?
We look for 2-year history, salaried and also self-employed. So for self-employed employees, we would request 2-year tax returns. And now
Okay.
that we are in the mid-year, we will ask the year-to-date profit and loss statement to make sure that the income is moving up or equal to 2019.
Okay. And like, what do you do? What does the bank or what do the lenders do differently as far as verifying employment or anything now that, I know you mentioned some of the ratios might have changed a little bit, But
Yeah.
what are they doing in terms now differently because of COVID?
Um, right now with salaried borrowers, before we close, we will do a verification of employment. If
Okay.
we're closing tomorrow and they know we're getting a pay stub tomorrow, they may request for the pay stub before actually funding the loan.
Mhm.
For self-employed borrowers, they may request bank statements showing activity, money going in. They may even go online to check to see if the facility is open or make phone calls to the office to see if it's up and running.
Okay. Interesting. And what as far as like timeline, like what is the normal timeline to close either like a a renovation loan, what you call a 203K, or an FHA 3.5% down type of loan.
Comfortably, I say 45 days.
Okay. Okay.
45. It's really important to gather your contractor documents all up front. That's what usually takes the longest with 203K loans. So if the borrower can take care of that up front, then I see no reason why we couldn't close. When the appraiser go out to the property, that's one of the items we would need. So the appraiser could base the appraisal report based on the after completed value. So as if the house was already renovated.
Okay. And that's an interesting point. So let's say, someone buys a house for 500,000, the contractor estimate is 50,000. So what does the bank look for the after repair value to be?
On a conventional loan, we need it to be 75%.
Mhm.
And on a 203K, we can go as high as 110%. So even if the value came in a little bit on the low side on an FHA loan, as long as it's within 110%, we should be fine.
How does that work with the numbers? So let's say it's 550. You're saying with a conventional loan, they're looking for it to be worth basically 25% more, something like that. Is that what you're saying?
Correct.
Yeah. Okay. And with a 203K loan, if you finished a renovation, you bought it for 5 and you put in 50, you're at 550. If it's worth 550, then it's okay.
Correct.
Okay. Interesting. Very
If
interesting.
it's a little bit lower, it's okay also. If it comes in, give or take 545, 540, we're still okay.
Hmm. Okay. Okay. So yeah, I mean it's I think the 203K, the FHA, you know, uh, conventional type of loans. These are all things that are just really great tools for people to get their first properties. And
Yes.
it, what are you seeing like? Because you've been working on these, this type of financing for 16, 17 years. Are you seeing, has it changed any in all of that time, or has it pretty much stayed more or less the same?
It's pretty much the same. Due to COVID, of course, everything was put on pause, but now everything is opening back up because we deal with the Department of Buildings and all that good stuff with permits and all that stuff. So now that, it's opening slowly but surely, we're opening back to doing the renovation loans.
Okay, that's great. Yeah, I think that that it goes hand in hand. I think with what we're we're seeing. We're seeing activity in the real estate market. I'm seeing that, like for example, I work a lot. Besides in Manhattan, I work in the Bronx as well. And I had a property that was in the Bronx and was a two-family house. We went to contract before COVID. Unfortunately, because of it wound up falling out of contract, and then we put it back in the market towards the end of the pandemic.
Hmm.
And just because there's not much inventory, and we wound up getting another person, another couple
Hmm.
that is buying it, and went to contract like 10 days ago, and at the exact same price. So
Gotcha.
yeah. So I mean, because of the last couple months, no one's been putting anything in the market, so the supply has been very restrained, very constrained because of that. And
Hmm.
so I'm seeing like in certain areas, like definitely a pent up amount of buyer interest. Are you seeing like the same things with your people that you're working with, that they're having a little bit of a hard time finding anything for sale.
Yeah, yeah, but it's picking up now. Now that the weather is nice, I'm assuming a lot of people are starting to put the properties back on the market. So I'm getting a lot of pre-approval requests and a lot of people, getting fully executed contracts. So that's a good sign.
Yes, yeah, absolutely. I mean, I think that once we started to see, phase two get announced, and once, we started to see that there was a light at the end of the tunnel, I think then I started to see properties start to go into the market.
Right.
And, so I think that'll be an interesting kind of, interesting story to see, going forward, because the programs that you work on are geared, can be geared towards properties that need repairs, or properties or foreclosed properties. And, one thing that, you know, that I've noticed is in multifamily properties in certain places, if the tenants are not working, or they're if they're students and there's no school, it makes it very difficult for the landlord, because now all of a sudden the landlord's not getting income, and he has a mortgage that he has to pay. So I think that going forward, we're probably going to see more of these properties
Yeah.
going into the market.
Yes, for sure.
Yeah.
Even with
So
the borrowers, I had a deal where, everything was going smooth, and then the wife got furloughed. But luckily, the husband's income was able to carry everything. So you're seeing that as well.
yeah, and I think that that's, um, we can't, discriminate based upon like source of income or anything like that. Um, but I think that it's one of the questions that we ask people is, are you working right now? Are you, what are the prospects going forward? Because as we
Right.
prepare and like brace ourselves for hopefully, not a catastrophic second wave, but we know that, other countries that have, like in China, that have gone through it, are in some cases getting re-quarantined, and so as we look forward towards what may be around the bend for us, it's an interesting question to sometimes to understand like what the person's prospects are,
Hmm.
for the future employment, because we could go to contract today, if I'm selling a property, and then we still have, like you said, about 45 days to 60 days to get it closed. So we
Right.
gotta make it through that period and get it closed for the seller and for the buyer.
Now,
So
fingers crossed.
yes, absolutely, absolutely.
Yeah.
So I could say for firsthand experience, I know for a lot of people, especially if this is stuff that's new, there's definitely a lot of questions, and it can be a little bit confusing. But I think the gist of it, in summary, is that, well, talk to Marsha, but basically, the gist of it is that there are programs out there where you can get your and that's a good question. Just before we close, is just, does it have to be their first property, or can a person, you can't buy an investment property with like a 203k or some of these programs, correct?
There's a conventional program for investors, and it's only for a single family home.
Only for a
For
single family.
the
Mhm.
for the 203K loan, you can have another property that's an investment property, but to own and occupy, that property has to be, basically, that can be FHA. Sony May, there's different programs. NRP, again, you can have another property and purchasing the new property that the borrower is going to move in. But the other Sony May programs, you cannot have a property within the past 3 years. And they could verify that through the tax returns.
Okay. Okay. Gotcha. So yeah. So as I said, talk to Marsha. She's the expert on this stuff. But just know that there are programs out there that you can get potentially your first home with as little as 3.5% down. And we didn't really touch on it, but there are closing costs when you buy a property, and you can even put that into the mortgage and the sale price. And so you can put
Absolutely.
that, you can put the renovation costs if there's a renovation needed, and you can see there's all different types of credit that it's available to. So I think if you're able to, save a little bit of money, 3.5, 4%, as Marsha was saying, you can get your first home. So Marsha, like if people have questions or if they want to do a loan with you or, do a pre-approval, what's the best way for them to get in contact?
You can contact me at 646-773-52 Morency at unmb.com, United Northern Mortgage Bank.com. UNMB.
Okay. We cut off a little bit there, so I'm just going to repeat because I know what you said. So
Okay.
I'll put a link to everywhere for it, but it's Marsha Morency, so it's M like Marsha Morency, Orency at UN like Nancy MB.com for United National Mortgage Bank.com.
United Northern Mortgage
Northern?
Bank. Yeah.
United Northern Mortgage Bank.com. So Morency at UNNB.com. And I think the other number you gave might have been your cell number, correct?
Yes. Yep.
Okay. So I'll make sure I'll put a note on the post and where this goes out so that people can either call you on your cell or shoot you an email.
Perfect.
Right? Yeah, thank you so much for taking out your time. I know you're very busy, and I know you have a family as well. So I know you have a lot of things going on. So really thank you very much for coming and joining on the Facebook Live, which posted, and we'll be talking soon. Thanks again, Marsha. I appreciate it.
Thank you for having me. Thank you. I really appreciate it. We'll be in touch.
Okay, you take care.
All right.
Okay,
Bye-bye.
bye-bye. Bye.